Welcome to the 3-Edge Week in Review for the week of August 21st. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. This week, Steve and I will be discussing how current market psychology doesn't necessarily match market reality when evaluating investment performance. And we'll consider what happens when we apply a slightly longer time frame beyond just year-to-date 2023 to that investment performance across asset classes. But before we get to that, a quick recap of the activities in the markets this week. And obviously the big news this week came on Friday. Friday morning, Fed Chair Powell gave his address to those gathered for the annual Kansas City Federal Reserve Jackson Hole Symposium. And for the most part, Powell stayed on message in his remarks. He stated that the Fed is prepared to raise interest rates further if needed, and there will be more economic reports coming between now and that September FOMC meeting, and that will shed additional light on inflation, the strength of the economy, strength of the labor market, and all of that data could ultimately influence the Fed's decision at the FOMC meeting in September. So, Steve, let me bring you in here, and I want to talk about something I've been thinking a lot about lately. We know investors say that when it comes to investing, they're focused on the long term. However, this year in particular, as the U.S. equity markets like the S&P have climbed higher, investors, they seem to be almost exclusively focused on year-to-date returns in 2023. And of course, often thinking is encouraged by Wall Street and the financial news networks, and they talk about things like buy the dip and the fear of missing out. So I'd be interested to get your take on this topic. Are investors potentially missing the forest from the trees here by focusing so much on year-to-date performance?
So Fritz, I agree with your insight. Many on Wall Street are promoting the idea that we're in a new bull market, and a lot of investors are following in lockstep. In fact, there are measures of investor sentiment that are showing some extreme bullish readings recently. We've seen that over the last few weeks. In reality, as you said, most investors say they're investing for the long term. However, market psychology and investor behavior very often overly influence what investors do, and investors can be overly influenced by daily market moves. And this is human nature. And it's not just private investors. It even happens with professional investors. So what we find is sometimes to see the forest from the trees, it's good to step back. Even if we step back a little bit, let's just say last couple of years, we can see that the reality is very different than what this recent market psychology might be signaling, what might be indicating. So if you go back, if you remember 2 years ago, we were telling our clients and we were telling our video viewers that at that point in August of 2021, that based on our measures of valuation, that at that time, the U.S. stock and bond markets were both highly overvalued, and we had a big caution flag. And the markets continued to go up until the end of 2021, and then we had the big correction. But back then we said, because of the overvaluation, the returns that an investor could expect, a long-term investor could expect over the subsequent 10 years, were going to be very small and not worth the risk until those valuations get back to something more reasonable. So now, here we are 2 years later. This is a good time for check-in.
All right. So let's do just that. Let's widen the aperture here and see what it looks like if we take a look at investment performance of a wider variety of asset classes. And as you suggested, let's look back 2 years. And what do we see in terms of the different asset classes and their investment returns if we do that?
So this is why we say that recent market psychology is being exposed by the market reality. Let's look at this table. And it certainly shows that U.S. stocks, whether you measure them by the S&P 500 index, which is the most popular, the NASDAQ 100 index of technology stocks, which is becoming increasingly popular this year, or the equal weighted S&P 500 index. Pick any three. You can see that over the last 2 years, U.S. stocks are just treading water and either making almost zero, very close to 0% gains or very slight losses. A lot of to and fro, a lot of rallies and corrections, and we've basically gone sideways for 2 years. 2 years ago, we said that the market would basically go sideways on average over the subsequent 10 years. Here we are 2 years later, and that's proving out so far. Now let's expand this. As you know, and as we discussed, there are many conventional investment practices that say, well, your best way to hedge against an equity decline is to buy longer-term bonds. Well, as you see, long-term bonds have been a terrible hedge, except, with one exception, that would be TIPS or Treasury inflation-protected securities, which at least have held their own. And then the final graph, investments that most people don't really consider as part of their normal allocation. If we look at cash as measured by U.S. Treasury bills and real assets like gold, you can see that these have actually outperformed over the last 2 years and are nowhere in the current market psychology right now. And I have to say the parable, the tortoise and the hare, comes to mind. Now, this next graph is going to show that. So you compare the NASDAQ index in the strong rally we're having this year, and it's capturing the imagination of many, and people are piling in. Think of that as the hare, and think of the U.S. T-bills as the tortoise, and you can see the tortoise is beating the hare.
That's astounding, based on what I think investors feel like this year has been like to look back there. So thank you. And now, of course, as always, my final question is, all right, based on what you've just talked about and what you've just shown us about taking a little bit of a longer term outlook, how should investors consider perhaps adjusting their investment portfolios based on what we've discussed here?
So we believe that U.S. stocks continue to be overvalued. And one measure that we've discussed previously in other videos is the price to sales ratio. It's a way of measuring, is this stock market expensive right now or is it cheap? And basically it's saying it's not only expensive, but the price to sales ratios are even higher than they were just before the tech stock bubble burst in the year 2000. So we continue to hold diversified portfolios that have allocations to the short-term treasury bills, to gold, to TIPS, and we do have allocation to U.S. equities, but they're at the minimum end of our ranges across our strategies. So in this way, you can see that we've been able to beat our benchmarks. You can see in this next set of charts, our strategy has been able to beat their benchmarks, and with a whole lot less volatility and subject to a whole lot less downside risk. Now, I want to go on to say that generally, while the U.S. market is so overvalued, our strategy has been to be patient, stay cautious, and wait until the market becomes more fairly valued or even undervalued. And then, because we have this dry powder in the U.S. short-term treasuries, which are now earning over 5% a year on an annualized basis, we also have, more importantly, you can think of it as dry powder, so that when the next correction comes and people are fearing and panicking and selling at the bottom, we have the dry powder to be able to swoop in and pick up those bargains at a lower price to sales ratio, which typically coincides with much more favorable average returns over the subsequent 10 years from that point. So, important point I want to make is that while our investment strategies, or you might call them defensive or cautious right now, this in no way means that we're going to be necessarily staying defensive for many years going in the future. Rather, we're being disciplined, we're being patient, we're looking for opportunities where maybe in the not so distant future, certain markets and even markets outside the U.S. might fall into that attractive zone, and where the economic factors are favorable, the behavioral factors are favorable, the markets are undervalued, and we feel confident we can make some very strong returns that way. So basically, we think the key is to not fall in that psychology trap of investing what's been hot over the last few days or weeks or maybe even year to date, but taking a step back, looking at the market reality, looking at the valuations, and then just when most investors are too fearful, a disciplined investor will take advantage and invest at that time, even though psychologically that might be the most difficult time to invest.
Excellent. Great. Well, thank you for your insight and for helping us to expand our perspective and expand our horizons beyond just the first 8 months of 2023 and also beyond just the S&P 500 when investing for long-term results. So I appreciate that. So that will do it for Steve and me for this week. As a programming note, next weekend will mark the Labor Day holiday, and so we will not be recording a video. We will be back after Labor Day with a regularly scheduled View from the Edge and weekend review videos. As a reminder, all our videos are available on our YouTube channel. And in addition, if you think someone you know might benefit from our videos, please feel free to share them. You can simply send them the link to the 3Edge YouTube videos. And we would be most appreciative since word of mouth is often the best way for others to learn about 3Edge asset management. So that will do it for us. On behalf of Steve and everyone here at 3Edge, we wish everyone the very best for a safe and enjoyable Labor Day holiday. And as always, thanks for listening.